Are you a hardworking dad, juggling family responsibilities while dreaming of building wealth through real estate? Welcome to the Invested Fathers Podcast, where we explore how to balance investing and fatherhood. I'm your host, Kenny Johnson, founder of East West Capital. Over the past 5 years, I've been buying real estate to free up my time and secure my family's future. Now I'm here to help you do the same. Join me as we navigate the real estate world together, building wealth and strengthening our families. As my grandma always said, East West, home's best. My son says to me, "What kind of shoes do bears wear?" I don't know. They don't wear shoes. They have bare feet. Hope you enjoy episode 6 of The Invested Fathers. In today's episode, we will be going over the process of a syndication and how it works. We'll also be going over a few key terms to get familiar with talking about syndications to your families and other investors. I'm also going to share the story of how I unfortunately lost $5,000 being a part of my very first syndication that hopefully you all can learn from. Let's get started. Investing in real estate syndication can be an excellent way to get involved in larger real estate investments without having to manage the property yourself. Here's a simplified overview of how real estate syndications work, especially designed for someone new to the concept. Let's just start by understanding a syndication is just a fancy way of saying group investing. It's a method where multiple investors pool their financial resources to invest in properties that are larger and more expensive than something they could afford or manage on their own. This collective investment structure allows investors to participate in real estate ventures like apartment complexes, commercial buildings, or large-scale residential developments. So now we're going to talk about the process of how it works to invest in real estate. A real estate syndication is typically formed by a sponsor, also known as a syndicator, who identifies a real estate opportunity, creates a business plan, and seeks investors to fund the purchase. The sponsor is responsible for managing the investment from acquisition through management to eventual sale. All right, the next step is investor participation. As an investor, you join the syndication by contributing capital toward the investment. Your contribution is pooled with that of other investors to fund the purchase and management of the property. Next is the legal structure. The syndication is often structured as a limited liability company, or LLC. It could also be a limited partnership, LP, where the sponsor is the general partner, GP, or managing member, and the investors are the limited partners, LPs, or members with limited liability. So those are some key terms you've probably heard throw around, the GP or the LP. Next is the investment and returns. Your investment entitles you to a proportional share of the income the property generates, such as rental income, and a share of the profits when the property is sold. The specific details of how income and profits are distributed are outlined in the syndication's operating agreement. So what's really cool about this is typically if you're funding some type of single-family home flip or a rental, your structure of your partnership with that individual is usually pretty limited. You're either getting an interest-only payment or you're some type of partner that's like a 50% or 30% or some type of ownership. This is similar but on a much larger scale. Typically with most returns on syndications, you're getting some type of preferred return, which is a payment that you get usually quarterly that gives you some type of cash flow. It's usually in like the realm of maybe 6 to 8%. And then you get what's called an IRR or internal rate of return, which is received when the property is sold or refinanced. And that number is usually in the range of 15 to maybe 20%, sometimes higher, depending on what the deal is. So let's get back into it. Passive investment is the next term. As a passive investor, you are not involved in the day-to-day operations or management of the property. The sponsor handles all aspects of property management from tenant relations to maintenance and financial reporting. Sounds good. Risk and rewards. Like any investment, real estate syndications come with risks, including market risks, property-specific risks, and risks associated with a syndicator's ability to manage the property effectively. However, they also offer the potential for significant returns, especially if the property appreciates in value or generates substantial rental income. And then lastly, the exit strategy. The syndication will have a projected timeline and exit strategy, which could involve selling the property after a certain period to realize capital gains or refinance the property to return some capital to investors while still retaining ownership. Something really cool that has happened in other syndications that I have been a part of or heard of are the ability to return the investor's capital completely while still being an owner of the property and being able to receive passive income or rental income while having all your money back, which basically means you have no more risk in the deal because all your money is back, and now you're just receiving the upside for the indefinite future. Key considerations for new investors. Let me just run through these 4 things pretty quickly. Number 1 is due diligence. It is crucial to perform due diligence on the syndication, the property, and the sponsor or sponsorship team. This is very important. Look into the sponsor's track record, the property's location and condition, and the financial projections. I think the number 1 thing here to understand is the track record. Obviously, there's a lot that goes on to any deal, but if you have a sponsor that's more or less tried and true, who is just rinsing and repeating his process since he's done the same thing for the last 10 years, you have less to worry about. Next thing is legal documents. Familiarize yourself with the legal documents involved, such as the private placement memorandum, the operating agreement, and the subscription agreement. These documents outline the terms of your investment, the structure of the syndication, and the rights and obligations of all parties. Sadly, this is typically in legalese, which makes it difficult to really get your mind around, understand what everything means. Sometimes these documents can be anywhere between 10 to 100 pages. So depending on how risk averse you are, you will want to know as much as you can about this information, and it should be available for you. Accreditation. Some syndications are only open to accredited investors, another term there, individuals who meet certain income or net worth criteria. So determine if this applies to the opportunities you are considering. The terms that you'll probably want to hear or be familiar with as well are a 506B offering or a 506C offering. The 506B are for non-accredited investors, which are typically your friends and family of whoever the sponsor is. And the 506C offerings are for everyone else who have $200,000 or $300,000 of income a year. Those are typically determined if you're a 506C accredited investor. And then finally, communications and reports. Ensure that the syndicator has a transparent communication strategy, providing regular updates and financial reports to investors. So syndications, they offer a way to diversify your investment portfolio into real estate with a relatively lower entry barrier without the need to directly manage the property yourself. But it's very important to thoroughly research and understand each investment opportunity and consider consulting with other investors that have invested into syndications to see if this might be a good fit for you to increase your own financial goals. I also mentioned that there was a story of my very first syndication and how I lost $5,000. I was a part of a team that was buying a college fraternity house in Washington State. It was me and 3 other investors, and we had been doing an extensive due diligence research on this specific building. We were under contract, and the realtor was basically telling us, hey, there's no one else on this deal. We really want you guys to close. And we knew this building had a lot of work that needed to be done, but the upsides looked very good. Well, during this process, we needed to pay for an engineer and a designer to make sure that more or less our due diligence was being performed well on what we wanted to do. Move walls, add bathrooms, etc. And unfortunately, to kind of cut to the chase here, another buyer was in the wings that we did not know about. And the realtor that was representing the seller was being, in my opinion, very shady and was using everything we were doing to increase the bid for this other person who I think had also done a lower offer than what they were asking. And we fell out of contract during the negotiations of the price. And unfortunately for me, I was part of the sponsorship team, and one of my duties was to pay for these 2 fees of this engineer and this design, and I did not get that money back. So thankfully, it actually was not presented to any LPs or any other capital raising partners. So that is my story of how I lost $5,000 in my first real estate syndication and how I learned the importance of being under contract with a team, that there's no legal way that we could fall out of contract, even if we were negotiating a price. I hope you enjoyed today's episode. And this is Kenny Johnson, your host, signing out, saying East West, home's best. Thank you for listening to this episode of the Invested Fathers podcast. If you liked this episode, we would love for you to click subscribe and leave us a 5-star review. We appreciate all of your hard work as a father and look forward to our next episode together.